So Curtis from Missouri says, when is the market going to correct and reflect what Biden is doing?
Okay. It never will. All right. So here's the thing. And this is just goes back to pure economics. Government spending equates for 15% of our total GDP. Corporate spending equates for another 15% of our total GDP. Consumer spending equates for 70% of our total gross domestic product. So what we do as a consumer drives 70% of economic activity. The thing that drives me crazy more than anything else, Chris, is that our politicians want everybody to believe that it is they, the politicians, who are the ones that are making things great. And the reality is that it's us.
Right.
It's us waking up in the morning and brushing our teeth and turning on our electricity and driving our cars and going out to eat and, having birthday parties for our kids and doing, events, going to concerts, going to sporting events. It's us living our lives that drives 70% of our economic activity.
Starting your route to retirement.
Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group, your host of the Guided Retirement Show. Welcome to the 50th episode of the Guided Retirement Show. So excited today to answer questions from many of our viewers and listeners all around the country. Joining me today is Chris Rett. He's a certified financial planner here at Barber Financial Group. He's going to be my MC today. He's going to read the questions, I'm going to answer, and we're going to have some dialogue. And I know that as we're going through these questions, you're going to have additional questions of your own. There'll be a link in the show notes where you can ask those questions and get access to many, many resources. Please sit back, relax, and enjoy the Guided Retirement Show's 50th episode. Chris Rett, certified financial planner, Barber Financial Group. Welcome to the Guided Retirement Show. And this is our 50th episode. We have so many questions that have come in from all across the country, from our YouTube viewers to our regular listeners of the podcast. And I've invited Chris Rett, again, certified financial planner at Barber Financial Group, one of the many. And you're going to be my MC today, Chris. So you're going to be reading me the questions from the listeners or the viewers, whichever venue they're paying attention to us on. And you and I are going to have some discussion around these questions. And before we get started, I think it's really critical to remind anybody that's watching us on YouTube, listening to us on the podcast, that we're here to answer questions that pertain specifically to you. And it's hard. We're going to get some great questions here. We've got some great answers, and we're going to have some good commentary, but it's really critical that people get the answers to their own personal situation. So check out the link in the show notes where you can click that link and get a complimentary consultation. That means a visit with one of our certified financial planners to get your questions answered. So, Chris, first of all, I didn't even ask you before I asked you to come on to join me here on the podcast.
Sure.
Have you ever done anything like this
Never
before?
done anything like this, so very excited.
All right.
Thank you for having me.
Absolutely. All right, so let's get started with some of the questions.
Sure. So Linda from Kansas, thank you for listening in. Linda writes, I'm 70 and I'll have to start my RMD in 2 years, and I really hate that. I've heard that there might be a push to get rid of RMDs altogether. What is your prediction for the probability of timeline of that occurrence? Linda also had a follow-up question that's related in two parts we'll get to. So she apologizes for the duplicate question, but please warn your listeners, I just found out that I'll have to take my RMD from my work Roth 401k, even though I won't have to pay taxes on it. This makes no sense, Linda writes. So, but I've been advised that I can convert to a Roth IRA just before retirement, so I won't have to take the RMD. Who makes up these rules, Dean?
Okay, so first off, the Roth IRA was introduced back in 1997 by Senator Roth, probably the best piece of legislation ever written. Mm-hmm. And Joanne Huber, our lead CPA, as well as Ed Slott and we discuss the Roth IRA and RMDs in several other episodes of the Guided Retirement Show, episode 1, episode 2, episode 18, 35, 31, and 45. We've had a ton of discussion around this. But first of all, the Congress makes up the rules.
Sure.
And so the idea behind I'll take the last part of that first. So the 401k has a required minimum distribution, even if it's a Roth 401k, if you've reached age 72 and you're no longer working. Now, if you're still working and you're 72 years old, the RMDs do not apply on the 401k. However, if you take that money out of the 401k and roll it to an IRA, if it goes to a traditional IRA, RMDs will apply. If it goes to a Roth IRA, RMDs will not apply. RMD rules are very, very specific and they're complicated. And the problem is that if you mess up on an RMD, it's not just it's okay type of a thing from the government. It's a 50% excise tax.
Yeah, the government's not very forgiving.
Right. And again, there's no do-overs.
Right.
So make sure that you get these right. This is where it's critical to have a good financial planner that is familiar with the tax laws as well. And as to the first one where they're talking about getting rid of RMDs, they're not going to get rid of it.
Right.
Look, think about it this way. The required minimum distribution is the easiest way for the government to increase revenues without raising taxes. That's the same thing that they did with the Secure Act of requiring money to come out of an inherited IRA within a 10-year period. They're going to increase revenue to the Treasury without increasing taxes by forcing more money to come out of those retirement plans that have never been taxed.
Makes sense.
All right, let's move on.
Okay, so Todd T. in Missouri, is it better to have contributions going into regular 401ks, Roth 401ks, or a combination of both? I have both options in my 401k. If both, what percentage in each account? This seems to be a common question we get time and time again.
It's a really common question, and I think it's a critical question. So anybody that's listened to me on the Guided Retirement Show for any period of time or on America's Wealth Management Show, which is our radio program, I say that you should never put your money into anything until you know what the rules are going to be when you want to get the money out. Right?
Makes sense.
What are you going to do with that money? So, Todd, we could answer the question in a couple of different ways. First off, it really depends on your tax situation now.
Yep.
And what tax situation you think you're going to be in the future. I will tell you that, let me take a person like myself, mid-50s, peak earning years, and I have the ability to put into a tax deferred or a pre-tax, the regular portion of our 401k, or I can go into the Roth portion of our 401k. So what I'm going to do is I'm going to look into the future and I'm going to say, okay, when I retire, will I be in a lower tax bracket then, knowing what I want to spend, or will I be in the same tax bracket, or will I be in a higher tax bracket? I will make my decision based on that. If I believe that I'm going to be in a lower tax bracket in the future when I retire because I projected out where I'm going to get my income from, et cetera, I'll use the traditional so I can get the deduction today, and then in those early years of retirement, I'll do some Roth conversions. If in fact you're young and you haven't hit your peak earning years and you got a long time to let that money accumulate,
and taxes could be increased in the future.
Right. I'm a big fan of the Roth at that point. What do you think, Chris?
I like that. Yeah. And I think it's important to understand too, a lot of people that come to us don't realize that employer plans that match, the matching is already going to be tax deferred. So if you're looking to hedge some piece, some might be considered for the Roth as well.
Right. Now, I don't know if you know this. I think you probably do. But there's a caveat to that. There is actually legislation before Congress right now that was passed with strong bipartisan support through the House Ways and Means Committee in a new act called the Son of the Secure Act, where they're proposing to allow the employer to use a Roth contribution. If you're contributing to a Roth part of your 401k, the employer portion of that would also go into a Roth 401k.
That's fantastic. No, I had not heard that.
Okay, what does that do, though? Here's the question. What does that do? Why would they do that? Okay, it's after-tax money that the employer is putting in.
So they get the revenue.
So they get the revenue now as opposed to in the future when the money comes out.
Makes sense.
Okay, so anytime the government does something, you have to ask yourself, what's the ulterior motive?
Yep, or what's in it for them. Yep.
Right.
Exactly.
Yeah. All right, we got Bruce from Kansas. What do we got from Bruce?
Bruce wants to know, what are your thoughts or recommendations on converting tax-deferred 401k funds to an index universal life contract? This strategy is being recommended by other financial planners, but seems to be very complex and needs to avoid becoming a modified endowment contract, also known as a MEC.
Okay, so I could go on to a huge tangent here, Bruce. What I will say is this, is that if you think about insurance in its purest form, insurance is supposed to be a transfer of risk. All right. So life insurance in its truest form is meant to ensure the life of an individual and protect the people that individual leaves behind in the event that that person's no longer able to provide for the family. Okay. It can also be used to pay for estate taxes and things like that. I've never been a huge fan of looking at life insurance as an investment. So in other words, overfunding that life insurance policy, taking money out of an IRA, putting it into a life insurance policy with the promise of tax-free income in the future. All right, here's the secret. This is how it works. All right. So what happens is I'm going to take the word life insurance out of this for just a second, Chris, and I'm going to use car insurance as the example. All right. So let's say that you are driving your car, and we'll just, for sake of the podcast here, we'll say we're driving a Chevy pickup. Okay. And it's costing us $1,200 a year or $100 a month to insure that Chevy pickup.
Yep.
We've got all the regular limits of liability, the collision, all that, good deductible or whatever. And the insurance agent comes to you and says, hey, Chris, we got a new policy here. We got a new car insurance policy. Now, it's going to have the same limits of liability. It's going to have the same collision, all the other same deductible. That's all you're going to say. But the difference is, instead of you paying $1,200 a year, we're going to ask you to pay us $10,000 a year. And then what we're going to do, the insurance company, we're going to take that money and we're going to put it into these indexed funds over here.
Yep.
And we're going to make some money on that. Okay. We don't know how much. We're going to just promise you that you're never going to lose anything, but you made average 5 or 6% on that money over time. Okay. If you're lucky. And if you want to use that money in the future, we'll loan it to you.
I'm not following. Yeah.
But that's the way life insurance works, Chris, right? You overfund a policy that's meant to provide a death benefit. The insurance company takes that money. They make money on it. You want to use it, you have to borrow it. The reason the income from those universal life policies is tax-free is because it's a loan. It is a loan of your own money, okay? And by the way, you already paid taxes on the money when it came out of the tax-deferred plan. Now you put it into the tax-free plan. When you're spending your own money, it's not taxable. When you borrow money, it's not taxable.
Right.
Look, you'll never, ever, you can't make the math work on these things. You can't make the math work. Have you run into this, Chris?
I have run into this a lot. And what I always tell clients that come to me is the first rule of thumb is, if it seems to be complex or you can't explain it to a 5-year-old, you ought not to invest in it. That's my general rule of thumb. The second thing I always look at is, we talked about it before with the government, is how's the person getting paid? A lot of times advisors use these commissionable products to pitch the idea of what could happen in the future. And they don't recognize that they're getting a big upfront commission. So they're not really there to stick around for the long haul if they get an upfront commission.
Right. Most of these policies like this, I'm not going to say all of them because a lot of them are different, but most of them will pay the insurance agent. Okay. I won't call them a financial planner. I'll call them an insurance agent.
Yep.
Okay. Or a financial salesperson, because that's really what they're doing here.
Yep. That's more accurate.
They'll get a commission that's maybe 100% of the first year premium. Okay. And who's going to win? Insurance company wins, and the insurance salesman wins, and the individual that loses is the person that does that. Don't do it.
Yep.
Bruce, I'm going to tell you, don't do it.
Yep. And the other thing that flies under the radar, I think, a lot of these policies is these insurance companies will change the crediting options year 1 or year 2. They're not obligated.
You're right. They can change the rules anytime they want to.
Absolutely.
On any anniversary date. Guess what? You're stuck with it. And they know that.
So what sounds like 100% of the S&P 500 quickly gets reduced to capped at 10%, 9%, 8%. We've seen it happen all the time.
Yeah. I don't like them.
Yeah.
And Bruce, if you need us to walk up against whoever is telling you to do this and we can analyze it for you, we're happy to do it.
Yep. So Curtis from Missouri says, when is the market going to correct and reflect what Biden is doing?
Okay. It never will. All right. So here's the thing. And this just goes back to pure economics. Government spending equates for 15% of our total GDP. Corporate spending equates for another 15% of our total GDP. Consumer spending equates for 70% of our total gross domestic product. So what we do as a consumer drives 70% of economic activity. The thing that drives me crazy more than anything else, Chris, is that our politicians want everybody to believe that it is they, the politicians, who are the ones that are making things great. And the reality is that it's us.
Right.
It's us waking up in the morning and brushing our teeth and turning on our electricity and driving our cars and going out to eat and, having birthday parties for our kids and doing, events, going to concerts, going to sporting events. It's us living our lives that drives 70% of our economic activity. Now, can Biden slow economic activity because of, penalizing people, raising taxes, putting more regulations on businesses and things like that? Yeah, but the impact is so small, and it takes a long time for that to take effect. So what Biden's doing today is all about what, his party is known to do, which is want to grab more power, make everybody believe that it's them that is why America is so great. But the reality is, Americans are why America is so
people.
great.
Yep.
Yeah.
Driving the economy.
It's what we do. So it's a great question. It's one we get all the time. So, politics don't affect the market the way that everybody thinks they do.
Yeah. Markets don't favor a political party over the other.
That's right.
David R. in Kansas says, what inflation rate are you currently building into your retirement plans?
All right. This is a complicated question, but it's critical because we see a lot of people that are building in inflation rates as they've seen inflation over the last decade. Maybe it's 2, maybe it's 2.5%. I think that's suicide, right? So a core inflation rate is about 4%. That's what we're going to put in. But you have to think about inflation in terms of what are you inflating? Let's take healthcare for an example.
Right.
We're inflating healthcare at 6.5%.
Yeah.
And that might be too conservative.
Absolutely.
We may need to reflect inflation higher than that on healthcare costs. If you go into retirement with a mortgage, and let's say that your mortgage payment is $1,500 a month, and it's going to be that way for the next 10 years, and then it's paid off, there's no inflation on that $1,500 a month.
Right.
Okay. And you can look at how often are you going to replace vehicles, or what's the inflation on vehicles? How often are you going to what are you going to do for travel, energy, those types of things? You should break that down in a budget, and you should inflate different expenses at different rates if you really want to get accurate about it.
But you're saying the base that we run it in our plans is 4%.
Yeah.
Okay.
Yeah. And the amazing thing is, Chris, you know this as a certified financial planner, that if you run a plan at 4% and then you run that same plan at 2.5%, you're going to get totally different outcomes.
Yeah. And we always coach our clients to say, we want to plan. We want to be overly optimist when it comes to your retirement, but we want to be pessimist. We want to plan for the worst case scenario.
Exactly.
When it comes to planners.
That's what you have to do. That
Absolutely.
way we're prepared.
Yep. So Robert R. in Missouri says, has another question on inflation. So seeing inflation rising and bad Washington policy, how soon will you reallocate profiles? Also being retired, will you reallocate different than a 30-year-old who is building his portfolio? Okay,
so first of all, I want to direct Robert to, first of all, there's a link in the show notes here, and you're going to find a lot of different resources there. So we go back to Bruce, where he was asking about the universal life.
Yep.
There's a video that'll be out there called Never Be Sold Insurance. There is also a retirement plan checklist that talks about how to put inflation properly into your retirement plan. Also out there, through that link in the show notes, is an article, Lumber Commodities and Inflation Fears, where we wrote this article not too long ago, and it basically flies in the face of what mainstream is saying is this great inflation coming, because this inflation that we see is, we believe, temporary. So we don't think that inflation is really going to become a factor for probably another 2 or 3 years. And there's a lot of reasons behind that. But the bottom line is, we're not going to make a knee-jerk reaction to adjust a portfolio because of a couple of months of inflationary data. We need more information, and we need to be convinced that this is a longer-term issue. And inflation is one of those things that doesn't sneak up on you. You can see it coming.
You can read the tea leaves. Yeah,
you really can. But the other part of Robert's question is that we will reallocate the portfolios based on 2 different scenarios. Number one, if they get out of balance for where they need to be, and number 2, if the objective of your overall plan changes that requires a change to that allocation. And obviously, the thing that we're looking to do is try to be as conservative as we possibly can and still maintain those goals. And we will always reallocate differently for somebody that's in retirement versus somebody that's 30 years old trying to grow their money.
Yep. So Howard K. in Missouri, traditionally, is it suggested that it is best to hold off taking Social Security till age 70 if you don't need it now? Lately, I've been hearing discussion around taking it now. He's currently 66 and a half and investing it, suggesting one may earn more in the investment market than you would gain by waiting. Your thoughts on this approach?
All right. So first of all, I'm gonna direct Howard out to a couple of other episodes of the Guided Retirement Show, episode 34 and 39. Mark Kiner, Jim Blair, Social Security Decisions Guide, all out there through that link in the show notes. It's 34 and 49. I'm sorry. And so to answer the question here, when you should claim your Social Security is a really personal thing. So, and it's going to depend on your own personal situation.
Always a unique scenario.
There is an 8% increase in the benefit per year for every year past age 66. And so, in some cases, I don't know anything about whether Howard's married, whether he's not married. If he's single, you probably could take it and maybe you can invest it. It depends on how long you're going to live.
Right.
The longer you live, the longer you wait, it helps, right?
Absolutely.
If you've got health issues and you think you're going to make it to 75 in Howard's case, take it now. Okay. This is not a decision that is one that you can say, here's a rule of thumb. I would do this or I would do that. What I would say is, Howard, let us put your personal situation into our guided retirement system.
Yeah.
And let's see what makes the most sense, because we can actually show taking Social Security now versus taking it at 70, investing it, and then see what does that do to the overall plan? What does that do to your ability to spend what you want to spend throughout your retirement? That's really the answer I think that most people want. What's my goal? Am I trying to accumulate assets or am I trying to just increase my income?
Mm-hmm. No, and for other listeners out there that are considering taking early to beat the market, 8% guaranteed year over year is tough to beat.
It is. And so again, it depends on if you're married, right? Who's the older? Who is the main breadwinner? Which one do you want to maximize?
Yeah. Health concerns, longevity.
Yeah. I mean, as many people look, when I wrote the book, Social Security Essentials, all the way back, I think in 2009, where we talked about the hundreds of different ways that people could claim their Social Security. And of all the people that have come into our office and we've run the planning and we've looked at their Social Security claiming strategies, it's very rare that you find two people that it's exactly the same thing.
Rarely is anywhere,
Yeah.
So, no, that makes complete sense. So Paul A. in Kansas, in retirement, with the exception of upfront fee, why are annuities bad? At least for part of a person's portfolio, at least for part of a person's portfolio. In retirement, I need to know what my income stream will be. I may miss out on some of the upside of the market from time to time, but I don't stress about any market correction during that time. Would be curious to know your thoughts.
All right. So we did a video, Paul, and that again is in a link in the show notes, called Are Annuities a Good Investment? So just about all these questions that we've gotten, Chris, we've done extensive research. We've done either podcasts on them. We've got videos out there on them. So the annuity in and of itself is not a bad investment. And I don't think anybody could say annuities are bad.
It'd be like saying all cars are bad.
Right. Okay. What's happened is that the annuities they've gotten sold by financial salespeople. It goes back to the whole thing with the guy with the life insurance question.
Bruce. Yep.
It's just, okay, what am I trying to accomplish here? What is the annuity actually giving me? And what am I giving up
Absolutely
in return? Okay.
There's always a trade-off.
There's 100% of the time there's a trade-off. Okay. If there were such a thing, Chris, as an annuity that never had any surrender charges, it never had any upfront charges, it had the ability to give me tax-deferred growth, it had the ability to give me a guaranteed income without any trade-offs, and I can change my mind and I can do things different with it in the future, I'm all about it.
We would sign up for one.
Right. Those don't exist.
Right.
Okay. What happens is that it's, again, you're talking about an insurance company who is going to guarantee you a stream of income for life. You're going to give up something for that guaranteed stream of income for life. And as many different types of annuities there are out there, and then the number of different insurance companies that are issuing those annuities, you're going to find different rules within all of these different annuities. So now there are some annuities today that are what we would call a fee-only annuity, which means that they are for fiduciaries. They're for RIAs that they don't have any upfront costs. They don't have any surrender charges. You can take your money, do whatever you want with it anytime you want to. You get the tax deferral, and there are some reasonable benefits that some of those have. I tend to favor the flexibility. But if you've got limited resources and you know that you have to have X amount of dollars, that money has to be guaranteed and it can't waver because all you've got is X amount of dollars plus Social Security, then maybe an annuity makes sense. But don't just go think, I'm going to go buy an annuity. Do the research and understand what your options are.
Well, and I think it's always a good practice too, just with anything, whether it's stocks, whether it's bonds, is I think there's a upper limit on how much you should take in your portfolio. I think the listener mentioned portion. I think what you're saying too is never, ever under any circumstances invest the whole farm on an annuity.
Well, that would be like saying, let's just go put my retirement plan in Bitcoin.
Seems reasonable. Yeah.
I know. But again, see what your money needs to do.
Sure.
Measure your resources, what you want to do. Go through, use our guided retirement system to create the plan and say, okay, if I put an annuity in here, does it improve my probability of success or does it detract from my probability of success? That gives us the answer in real math as opposed to, again, oh man, I got this great annuity. And again, most annuities, people don't go out and seek to buy them. They get sold by salespeople.
Absolutely. Yep. So it's just important to never overinvest in them and understand how they work.
Absolutely.
So Gregory in Missouri, I would like to preserve the gains made in my IRA portfolio, majority of it, which he claims is in VFIX. I'm retired at 65, having $700,000 invested and $1 million in the mutual fund. I'm considering a strategy that's called reverse dollar cost averaging. Each month I sell a fixed dollar amount and move it into cash. This protects a monthly growing portion of the gains and reduces the risk of loss should the market correct, yet allows for a portion to grow should the market fall. I guess this is a weak knee contrarian strategy. Yes, the crystal ball tells me the correction, follow record highs. I'm sorry, this is a really wordy.
Well, what he's basically saying here, Chris, is should I sell this S&P 500 index fund,
right,
which is what the VFIAX is, all at once? Should I preserve those gains? Should I take it out a little bit over time? And Gregory, you're asking a very legitimate question here on what you should do. Here's the way that I would look at this. I would say sit down with whoever your CFP is here at Barber, and let's plug this entire scenario into your financial plan. And let's look at what's really important to you. Let's look at what you want to spend, and let's measure the resources. And I would say that with where we are with the markets today, with the elevated market values, even though they can stay overvalued for a period of time, let's look at what's the portfolio that's necessary to allow you to accomplish all of your objectives with the highest probability of success and the least amount of risk. And then let's pare down the risk now. Okay. Let's wait for, the next 19 or 18, 24, 36 months. There's something coming. You and I know it.
There's always is.
Right? We don't know when it is, but we know when markets get this elevated that there is
a pullback.
Possibility of a pullback. We also know that in order to get price to earnings ratios back to where they need to be, that we need 3.5 years of zero return in the market to get the price to earnings ratios back down below 20. Okay. And so we're either going to see markets pull back or we're going to see almost nothing for a period of time. So just owning an index and that much of a portfolio, I would say it's time to address it more than just doing a little bit at a time. Find out what the portfolio needs to be with the least amount of risk that'll get you what you want, and make that decision and do it now.
No, I completely agree. And I think it comes back to, Dean, we can't say it enough, is having a plan and executing the plan.
Absolutely. You have to do that. I think Greg had a second question, right?
Yep, follow-up question. I know I can't use IRA funds to pay the taxes when I do a Roth conversion, but next year, couldn't I withdraw some of that converted money from the Roth and pay the taxes on the second-year Roth conversion, then use this as a rolling strategy until my traditional IRA funds are all completely converted?
Okay, so let's clear up some misconceptions here. You can use the IRA money to pay the tax on the conversion. That's very simple, right? The question is, does that make sense? So, Greg, again, what you want to do here is you want to run the scenario out, not just in a math problem and taking that IRA and putting it under a microscope and doing a Roth conversion analysis there. You want to do that Roth conversion analysis and figure out the tax consequences of that in the context of the overall plan, and that's the only way you're going to actually get the right answer.
Correct.
First of all, if I'm going to convert to a Roth, I'm not going to take money out of that Roth next year just to pay the taxes on a conversion I'm doing the following year. That to me doesn't make any sense.
Peter to pay Paul.
Because you can actually take the money out of the IRA as you're doing the conversion.
Correct. Now, is it true that before, for our listeners under the age of 59 and a half, that is there any type of prepayment penalty?
Yeah, you can't do that under 59 and a half, but in this one, that says he's 65 years old and retired. Yeah. So we don't have that 59 and a half rule here.
Gotcha. So Vincent C. in Missouri, can you do a multi-year forward-looking tax plan along with retirement income plan and distribution strategy while still working and not retired?
100%. And that's what you should be doing. And, if you think about it, let's say that you're going to retire at 65 and you're 55 today. All right, you can start to put that strategy together, because what we want to understand is, what are the resources you have today? What's the net income that you're going to need to have in the future? And, when are we going to claim Social Security? Is there going to be inheritance in the future? We factor all that into the plan. Then what we want to do is say, all right, in order to get the net amount after tax that you want to spend in retirement, where should we be saving today? That's the beginning part of creating that forward-looking distribution strategy. So the forward-looking distribution strategy, we have to step into the future and then that reverse engineer all the way back to today. And the question that we have to answer now and take action on is, where do we put our money now so that we can get that forward-looking strategy in the future? And we have to also understand that we have a bunch of sickos in Washington that want to change the tax code on us, it seems like every other year or two. And so we have to be flexible, and we have to know that a plan that we put together today may need to be changed in 18 to 24 months.
Yeah, no, I completely agree. And a scarier follow-up question to that, Dean, could you imagine planning it any other way?
No, but the thing is, you can do it. You can put it together, and you should.
Absolutely. Yep. So Judy R. in Kansas, I have funded my Roth. I made the trust. I funded my trust. I made the trust the beneficiary of my bank account and my IRA account and my Roth account. Is this correct?
Okay, so there's a big on trust. You have to understand that it depends on what you're trying to accomplish. As many different ways as you can think about, there can be a trust that can be made. Okay, so first of all, your trust should probably own the bank account, not be the beneficiary of the bank account. The trust, if you want the trust to be the beneficiary of your IRA and your Roth accounts, what that means is that the trust has to be a conduit trust. In other words, it has to see through. There has to be designated beneficiaries of the trust, and then the money basically flows through the trust to the designated beneficiaries. It can't stay in the trust. Well, it can, but if it does, the trust has no life expectancy, right? So if the money just flows into the trust and it's not a conduit trust where it flows out to other individuals, then what winds up happening is
the purpose.
Well, yeah, because the trust has no life expectancy, and because all IRA and Roth IRA rules are based on life expectancy, all of a sudden now that trust has to distribute 100% of the money, and it's all become taxable in the same year. So there's a lot of different ways and a lot of different methodologies. It really depends, Judy, on what you're trying to accomplish. If you're trying to control the distribution of wealth from those IRAs and those Roth IRAs, you probably need to look at an IRA trust. If it's simply just you want to make sure that the money's getting to the right beneficiaries and you don't want stipulations on how quickly they can take it out, just naming the designated beneficiaries, the individuals there, instead of the trust may be cleaner.
Okay. Carrie L. in Missouri. I was diagnosed with invasive breast cancer almost 5 years ago. I am 61. My husband is 62. I'm retiring next year, and I'll start drawing my Social Security early while my husband will continue to work till I turn 65. We are debt-free with the house and everything else. We have $600,000 in a 401k. House is worth $425,000. I'm thinking it makes sense for me to withdraw early and for him to take his late. Is she on the right track?
Okay, 100%. First off, let's say to Carrie, we're sorry to hear about your breast cancer. Well, let's hope that they've got everything and you live a long, happy, healthy life.
Absolutely.
But yes, you're on the right track here. So here's what I would say to this is that you taking at 62, absolutely. Your husband works till 65. You got $600,000 in a 401k plan. What I would want to see, and whether or not your husband should take at 65, would be this. What is the net income need that the two of you need? And what's the benefit of your husband waiting until age 70? Because remember, after age 66, you get a guaranteed 8% per year growth on that Social Security check. So in the event that Carrie's husband would pass on before her, it would be critical that she gets as much Social Security as possible. So the way that Social Security works here, Carrie, is that the first spouse to pass, the surviving spouse keeps the larger check. So I would be in favor of your husband, if it's feasible within the overall plan, of your husband delaying Social Security to 70, because if you pass on, he's going to need a bigger Social Security check. If he passes on, you're going to need a bigger Social Security check. So we want to get one of those checks as large as we possibly can if the plan works that way. Go to the link in the show notes, request a complimentary consultation, and we can actually give a definitive answer there so that you're making the exact right decision.
But to sum up, when somebody has a health concern, you are in favor of taking it early.
Especially for that person that's sick.
Yep.
Yeah. We've got to have some time to enjoy life.
Absolutely. While we're healthy.
Absolutely.
Kevin G. in Kansas, what specific areas of a retirement plan will be impacted by potential inflation, and what approaches are best to hedge against these inflation impacts?
Okay, so we talked about inflation here just a little bit ago, Chris,
Yep.
and essentially you want to look at all the different places where you're spending money and inflate those at different rates and based on what those are inflating at, and you want to make sure that you're doing that as you're updating that plan throughout the years. Potential inflation hedges are stocks. Stocks are an inflation hedge. Real estate's an inflation hedge. Commodities are sometimes an inflation hedge. Land, those types of things. Depends on where the inflation is flowing. But what the best thing to do here in this instance, Kevin, is to build these higher inflation rates into your plan, and then we can look at what asset allocation from a historical perspective has been able to provide the best protection against that and be able to give you that increased income in the future.
Oh, that makes sense. Connie H. in Missouri, supposedly the government may mess with our IRA and 401k accounts. What can we or she do to protect that?
All right, let's pair that up with Billy M. in Missouri. He says, what's all the noise we're hearing about 401k being in jeopardy from the Biden administration? And the reality is this. So there's a lot of talk out there. The only thing that's actually been signed into law is the Secure Act. And the Secure Act basically says when you pass on and the money passes down to the next generation, that the beneficiaries, your children, have to get all the money out of that IRA within a 10-year period, or the 401k within a 10-year period. There's no other legislation that's been passed at this point in time. So anything else that people are hearing is simply noise, right? And so until we have legislation, there's really no way to plan for it. There is talk about limiting the size of IRAs. So there's talk about limiting the size of an IRA to $5 million. If you get more than $5 million in an IRA, a Roth IRA, you're capped out. You can't get any bigger than that, so you have to start taking money out. That'll never pass, by the way, because that's just ludicrous that they would, even think that they would have authority to control something like that. But many times when you get some questions like this, I'm like, turn off the news.
Right.
Okay. Because, people are telling you things that are trying to scare you. And in a lot of cases here, they may be trying to scare you to sell you a financial product. So really be careful.
Well, not only that, you and I joked offline before this when we talked about the same conversations were had when Roth IRAs were started.
Right.
And we know the benefits of Roth IRAs. So it's important that we put down the pitchforks just now until we see how this could possibly benefit us before we start getting angry.
Yeah, it's interesting because back in '97 when Senator Roth introduced the Roth IRA, which I said at the beginning of the program today was one of the best pieces of legislation ever written, I had clients and I'm like, okay, this is the best thing ever. Convert it all.
Yeah, eighth wonder of the world.
Do it because you can spread the taxes out over a 4-year period. And I had people going, oh, no, that won't. No, I would never do that because why? I don't trust the government. And what's to say they won't change that law again in the future? The people that did it, Chris, have been laughing right?
all the way to the bank.
Tax-free income for the rest of their lives doesn't cause their Social Security to become taxable. It's been amazing.
Mm-hmm.
So I don't know what
change
you guys,
the channel. Yeah,
I don't know what you're hearing, but I would say let's not worry about those changes until they actually become law.
Well, and see and further see how it can benefit you first before we.
Yeah, but here's the key. Have a plan in place, a comprehensive financial plan. Use our guided retirement system, okay? And if you do that and that plan's in place, then you go, oh, there's a tweak to the law. Let's apply that to the plan. You can say, oh, here's how it affects it. And if it doesn't affect it in a meaningful way, then you don't make any changes. If it affects how it's going to pass to your beneficiaries, you make that change. If it affects your ability of how much you're going to get in income and be able to spend, then you address it at that point in time.
Oh, that's a great point, Dean, is that I know that we here have conversations all the time about what ifs and what coulds and things like that, only in the context that we show that we can pivot with our plans. It's not a matter of we're nervous about it, but I think it's important that all the listeners out there sit and think about is, hey, do I have a plan that can pivot in the event of something that could happen? Not that we're worried about it, but can I pivot?
Yep, you have to have it.
John A. in Missouri says, we have an 80-acre farm, and what would be the best way to leave that to my son? Either sell the farm now and leave him with the money or leave him with the farm and let him sell it?
It depends on Biden. I'm kidding. Well, here's where I say that. So right now, his son, John's son, would have what's called a step up in basis. So I have no idea what John paid for the 80 acres, have no idea what it's worth today. But if John dies and
but for the sake, we're assuming there's been some gain.
There's some gain. If John dies and leaves his son the 80 acres, then the cost of the 80 acres when John's son sells it is deemed to be the value of the date that he inherited it. Okay, so if you did it that way, there's no taxes due on the sale of the farm.
Because essentially they're showing no gains.
Right. If John sells the farm before he passes and then gives his son the money, there's pros and cons. You sell the farm and you got the money, but you had to pay the taxes at capital gains rates. But then again, you get a chance to see your son enjoy the proceeds of that farm. So, I mean, from a tax perspective, let him inherit the farm. Right? If it's more important for you to be able to see him enjoy that, or there's some things the two of you want to do together, and that's more important than not paying taxes on the sale of the farm, then go that route.
Yep, that makes sense. So Don from YouTube, I have a stock that for $0 that I got for $0 that's worth over $5,000 this year. Can I sell the stock and realize 0% gains, capital gains, paying only state tax, or can I convert that $5,000 of IRA money at 12%? Plus the state tax? Which option makes more sense here?
Okay, the question really doesn't make any sense because if it's $5,000 worth of stock and you're in the 12% or 10% bracket, you can sell it and there's no capital gains. But if it's already in an IRA, then the capital gains rates don't apply.
Correct.
So if it's an IRA and it's $5,000 of IRA and that's your only $5,000, then yes, you can convert it at the 12% tax rate. But if you have other IRA money, then the pro rata rule applies. So it's a more complex question than just that. So I would encourage Howard to get out to the show notes, the link in the show notes, get a conversation going with one of our certified financial planners.
Okay. Diane B, also from YouTube, at 67 and still working, she owns her own company. How much should she be putting into a Roth at a time?
Maximum $7,000 a year.
Okay.
$6,000 plus the $1,000 catch up.
Any backdoor?
At that age, probably not.
Okay.
Unless everything is in a solo K. But again, that gets a complex question, right? But if it's a simple answer to a question, how much can she put into a Roth IRA? $7,000.
Sense. Richard C. from YouTube. What are capital gains rates in a trust? Are long-term rates 15%?
Okay, if a trust or a trust is the owner of the account, you are going to hit the top marginal tax bracket on any earnings from that trust after about $13,600. I don't have the exact number right in front of me, but trusts pay tax at a totally different rate. It's their own deal, right? So if you've got money in a trust or it's in a state, then it's going to pay the top marginal tax brackets after it's under $14,000 of earnings, Chris. I don't know if you know the exact number off the top of your head.
I don't have it. Yep.
I think it's 13,600 is the number. Bottom line is you need to distribute that out to the individual. Okay.
13,100.
Okay. So I knew I was really close. 13,150. I know that you want to get that money out of the trust and distribute it to the individual so that it's taxed at their tax rate. Otherwise, if it stays in the trust, and that's where those tax rates come in, right? It stays in the trust and is not distributed. If it's distributed to the ultimate beneficiary of the trust, then it's taxed at whatever the rate that beneficiary is in.
No, that makes sense.
Okay, so listen, all of our listeners out there, all of our viewers on YouTube, we had a blast doing this, and Chris, you did a great job.
Thank you for having me
here on the Guided Retirement Show for the first time. Again, we know you've got questions. We know that those questions are critical. They're specific to you. So get to the link in the show notes. There's a ton of resources there. All the things that we talked about today, all the different episodes, all of the different white papers and videos and things, you'll find that out there. And there's a link through that same link, you can request that complimentary consultation with one of our certified financial planners. We can do it by phone. We can do it through a virtual meeting, or we're happy to meet with you in person. A special thank you for all of you who submitted your questions for our 50th episode of the Guided Retirement Show. You have made today a blast, and you're making Guided Retirement Show an absolute success with thousands and thousands of listeners and viewers all across the country. Thanks for joining us on the Guided Retirement Show. As always, if you're watching on YouTube, give us a thumbs up and subscribe, and make sure and share this podcast with all your friends and all your relatives.
Starting your route to retirement.
Investment advisory services offered through Barber Financial Group, an SEC-registered investment advisor.